Good morning. A warm welcome to all of you to this webinar on business combination under common control, or as we say, BCUCC, that EFRAC is organizing together with the Portuguese standard setter CNC and with OROC, the Portuguese auditing body, and of course with the IASB. As you see, this time with a Portuguese focus. So my name is Saskia Slompa. I'm working at EFRAC and I have the pleasure to introduce you to this webinar. So this is a further webinar that we have with the Portuguese focus. We had one very successful already in November on goodwill. And today as well, we have a very good turnout of people registered. We have over 250 people registered for today. So this is a very good score in our outreaches. And we are very keen to hear your views and the views of our Portuguese panel. That is very important to us because we will consider this input and the input from other outreaches in preparing our final comment letter to the IASB on the IASB discussion paper. So the deadline for our comments is the 30th of July, so still time to react. And we expect to issue our final comment letter somewhere after the holidays in September, after the process with our board and our tech. We would like to signal to you that we have also published two other documents that could be helpful to you. One is a summary of EFRAC's preliminary position, so a more summarized form and easier to digest, and a briefing document that explains actually the IASB discussion paper, so it makes this document as well more accessible for our audience. So what we will do today is, after the welcome by Lúcia Lima Rodrigues, we have divided this webinar into two teams. So there is one topic about project scope and selecting of the measurement method, and a second topic on applying the acquisition method, applying a book value method, and disclosures. So each of these topics will be introduced by the IASB, and we are very pleased to have the IASB board member, Tadeu Cendon, with us. And then the EFRAC position, the preliminary position, I have to say, will be given by either Chiara del Prete, our EFRAC Tech Chairwoman, or Filipe Alves, who is Senior Technical Manager at EFRAC. So the panel discussions will be moderated by Pedro Diaz. He's Chair of the CNC Private Sector Accounting Standards Committee. And then after all the panel discussions, Luisa Anacoreta will present the takeaways that she took from the discussion and what she heard today. And then Mário Freire, OROC board member, will close this webinar. So before actually introducing Lúcia to you, a little bit of admin. So this meeting is recorded and can be watched and listened after the webinar. The program, the slides you will see, the bios of the speaker, because we are not going to introduce them in all detail, you can all find on our website, as you can find as well the draft comment letter and the briefing note that I was referring to and the summary. They're all on the link that you were given in the email this morning. So we have a very eminent group of speakers and we encourage you to ask questions. So you will see at the bottom of your screen there is a chat box where you can type in questions. Given this Portuguese focus, we welcome both questions in English and in Portuguese. Although they may be answered in English, but you are very happy to type in as well questions in Portuguese, because you see all our speakers, with the exception of myself and Chiara, are able to handle Portuguese. We also have polling questions, and they will come up during the webinar. So we would like you very much to fill in these polling questions, so that we can see basically what you think as an audience about topics. And they, again, will give input to us in our final comment letter, our final positions. And they will also be very useful for the CNC Portugal to know, because they have to react as well. So that's all very, very good if you could do so. So you should have been able to see the first polling question. And hopefully you have answered so that we can see who is there today. Can we see that on the screen? Okay, well, people are still connecting, but we see already that perhaps not so surprising, many of people that are there are auditors. So which is very good. So this will develop over time. But actually, it's more important that you're going to complete the questions that follow, because that's really where we get the input from. And not only we, also the IASB and the CNC. So that brings me to the introduction of Lúcia Lima Rodrigues. Lúcia is Vice President of the Portuguese Standard Setter, CNC, and she is Professor of Accounting at the University of Minho. And she's a member of EFRAG's academic panel and a member of the European Accounting Association Stakeholders Reporting Committee, so the one on sustainability reporting. So you see, Lúcia is multi-topics, I would say. And she also presents Portugal at the European Commission Accounting Regulatory Committee. Over to you, Lúcia.
Thank you, Saskia. Good morning, everyone. Welcome to this joint webinar on the IASB discussion paper, Business Combinations Under Common Control. First, I would like to say that it's a great pleasure and honor for me and for the Portuguese Accounting Standard Setter, known as the CNC, to organize this joint webinar with EFRAG, the IASB, and the Portuguese Auditors Association. The CNC is proud to work with EFRAG and the IASB. This is our third joint event with EFRAG and our second webinar with EFRAG and the IASB. I also would like to show my appreciation for the participation of the IFRS Foundation again this year. I hope that our cooperation with EFRAG and the IASB can continue in the coming years. I also take the opportunity to thank the IASB and the EFRAG speakers, Tadeu, Chiara, Filipe, Camilo, Alves, thank you, and I express my gratitude to the panel members, Fernando, Araújo, Filipe, Romão, Mário, Freire, and Nuno Martins. I express my sincere appreciation to my colleagues from the CNC, Pedro, Aleixo, and Luisa, Anacoreta, for accepting the challenge to participate in this second webinar. I also thank the audience for joining us. I'm very proud to tell you that Mário Freire is not only a board member at the Portuguese Auditors Association, but he is also our colleague since he is a member of the CNC General Council. I also thank him for providing overview comments at the conclusion of this webinar. The topic we are addressing today aims to fill a void in IFRS standards. IFRS 3 business combinations doesn't specify how to report transactions that involve transfers of business between companies within the same group. Unfortunately, I couldn't find an empirical study that reports evidence of Portuguese practice on business combinations under common control. Therefore, I think this will be a good topic for a master or a PhD thesis. These combinations are frequently undertaken for many different reasons, and certainly in Portugal, we can't ignore that they are sometimes motivated for reasons of tax efficiency within the group. Company law requirements also can influence the accounting policies adopted by management. My practical experience tells me that Portuguese companies report these business combinations under common control in different ways, since they also can take many forms. In some cases, companies use the acquisition method established in IFRS 3, but in IFRS 3, this method is required only for mergers and acquisitions between unrelated companies. In other cases, Portuguese companies use the book value method, which measures assets and liabilities at the book values. There is also a variety of book value methods used in practice. Another concern I have is disclosure. Companies often provide little information about these combinations. thereby reducing transparency. Thus, there is a need to discuss this topic and to fill the current gap in IFRS 3. This webinar, I think it is very timely since the Portuguese accounting standardization system is being revised at the moment. Our accounting standardization system is composed of accounting standards that were adapted from IFRS and that are used by unlisted companies. The feedback on the topic that we will receive today will help finding a solution, since there is a need to reduce the variety of practices in Portugal. I'm very much looking forward to hearing the Portuguese perspectives on this issue. I wish you an enjoyable and highly productive webinar. I now invite Tadeu to address us.
Tadeu, over to you. Yeah.
Thank you, Lúcia. Thank you, Saskia. And thank you for having me in this event, especially with Portugal, due to the close relationship between Brazilian and Portuguese people. Thank you very much. Hello, everybody. As a reminder, any views that I express here today are my personal views and may not necessarily be shared by the board or the IFRS Foundation. That usually does it through the official documents. If you can just move to the next slide. Let me start with slide 6. Yeah. Yeah, thank you. Yes, I can see that. This diagram illustrating the type of transaction that we are talking about here. We have the IT company, IT co acquires software co from private co. IT co and software co are both controlled by the holding co before and after the transaction. That's what we call a business combination under common control. This project addresses reporting by the receiving company in a BCUCC, or business combination under common control. Sometimes I've referred as BCUCC. In our example here in this slide is IT co. The project is not about reporting by the controlling party in holding co or the transferor. It's just focused on the receiving company. Again, in our case here is the IT co. The receiving company can be listed or unlisted, closed capital, closed held capital, and it can be wholly owned by the controlling party, or it can have no controlling shareholders at all. In this project, the board focused on the information needed of the non-controlling shareholders, potential shareholders and lenders, and other creditors of the receiving company, because those parts must rely on general purpose financial statements for meeting their information needs. Therefore, it's supposed that those within the group would have access to the information more than just the one that are in the statement. Therefore, our focus is on these non-controlling shareholders that needs to focus on and actually rely on the general purpose financial statements. Next slide, please. And why is the board doing this project? Today, business combinations are covered by IFRS standards and are reported using acquisition method, which provides fair value information. However, for business combination under common control, this is not addressed. That actually is clearly out of the scope of IFRS 3. And in practice, what we see is receiving company using either the acquisition method, and therefore it provides a fair value information, or book value method, and then provide book value information. To help you to see the extent of the investing practice, this slide illustrates main differences between the acquisition method and a book value method. The acquisition method recognizes all identifiable assets and liabilities of the transferred company. I think that we have a delay in the slide. Can you just move? Yeah, thank you. Sorry about that. The acquisition method recognizes all identifiable assets and liabilities of the transferred company, measures them at fair value, and recognizes the goodwill as the difference between the consideration paid and the fair value of those assets and liabilities. On the other hand, book value method only recognize assets and liabilities that were previously recognized by the transferred company, measures them at, I would say, type of book value, and there is a diversity in which book value are used today in practice, and I'll talk about that later. It doesn't recognize, therefore, the goodwill because they are using the book value. Instead, the difference between the consideration paid and the book values of assets and liabilities received is typically recognized in equity. Under the acquisition method, the combining companies are combined prospectively from the combination date. In the book value method, that is divested in practice, and I'll give you again more details later. And finally, disclosures. Under the acquisition method, IFRS 3 requires comprehensive disclosure in the notes, and in a book value method, usually little information is disclosed. So, as you can see today, users of the financial statements of the receiving company might receive very different information about similar transactions. And what improvement is the board trying to do? The board's objective, if you can come back once, yeah, thank you. And what improvement is the board trying to do? The board's objective in this project is to ensure that useful information is provided without imposing unnecessary costs on preparers, and I'll explain later how the board is suggesting to achieve that. I mentioned user information, and what does it mean? It means information that is relevant and portray the economics of what is happening. Information that is comparable, so similar transactions are reported in a similar way, and finally, it's transparent. I mean, sufficient disclosure are provided. Next slide, please. Okay, with that introduction, I'll move on our first discussion topic, when the acquisition method and a book value method should be applied, and what are the board's preliminary view on this one. The board has concluded that one size does not fit all, and that both the acquisition method and the book value method are appropriate in different circumstances. It means it will depend on the facts and circumstances which method should be applied. The acquisition method should generally apply when the receiving company has non-controlling shareholders. However, there are, let's call it, special conditions for companies that do not have listed shares. In all other cases, suppose that a book value method would apply. This flow chart, next one, please. Yeah, thank you. Summarizes the board's view on when each method should apply. I suppose that most of you are familiar with that. I personally like that one. I think it's a very good explanation about the whole idea behind the discussion paper. I will explain a bit of that, not in detail, but just enough to give you an overview what's behind this flow chart. As I said before, the underlying principle for the board's view is whether the combination affected non-controlling shareholders in the receiving company. If it did, the acquisition method should apply, subject to a cost-benefit trade-off assessment. In the board's view, the benefits of applying the acquisition method would likely justify the costs in the case of public companies, because non-controlling shareholders, in their case, by definition, is relevant, so the acquisition method would apply. However, if the receiving company is privately held, no controlling shareholders may be small or may be entirely held by the related parts of the receiving companies, and then in this case, the benefits of the acquisition method may not justify the costs. And for that reason, there is an exception and an exemption for private companies. Both the exception and the exemption are aligned with what we already have in IFRS standard for other situations. This slide is to help, yeah, thank you. I have a delay here, but sorry about that. This slide is to help to explain why the board is suggesting the acquisition method for transactions that affect non-controlling shareholders. In the example in this slide, Holding Co controls several private and public traded companies. Software Co is wholly owned subsidiary, is a successful business that has created valuable software. Holding Co wishes to raise capital and decides to move Software Co from Private Co to IT Co, and then IT Co buys Software Co for cash at fair value. In this scenario, IT Co has no controlling shareholders, and the board's view is that it should apply the acquisition method. And then again, when you have the non-controlling shareholders, this is a kind of hint, a tip that you have to apply the acquisition method. That's the general principle behind, again, the discussion paper. Let's consider why the acquisition method provides better information to non-controlling shareholders of IT Co than, for example, book value method. If we look at the most valuable asset of Software Co, that's the software itself. Under the acquisition method, this asset would be measured at fair value. Under book value, it would be measured at its existing book value, which would reflect the cost to develop the software, but would not reflect its real value. Furthermore, applying the acquisition method, IT Co would recognize all identifiable assets and liabilities of Software Co and measure them at fair value, including its brand name. On the other hand, book value method would only recognize assets and liabilities that are already recognized by Software Co and report them at their existing book value. Applying, I think, can you just, yeah. This is slide 14, yeah. Applying the acquisition method, the difference between the consideration paid and the fair value of identifiable assets and liabilities received is recognized as goodwill, which reflects pre-existing goodwill in the acquired business and combination synergies. On the other hand, again, book value method, the entire difference between the consideration paid and the book value of assets and liabilities received of, in our case, 440, would be reported as a reduction in equity, which doesn't provide useful information about the values exchanged in the transaction. So under this method, there is no way for the NCS, no, it's still, if you can, yeah, sorry about that. I'll tell you when change the slide. Sorry about that. I should give you this command before. So under this method, there is no way for the non-controlling shareholders to assess whether the acquisition is a good deal for the receiving company and to assess subsequent performance relative to the price paid. And to conclude, from the point of view of non-controlling shareholders, it doesn't matter that IT Co and Software Co are under common control. For these non-controlling shareholders, this transaction affects their existing stake in IT Co in the same way as any other business combination, and fair value information in this situation about the Software Co is the most relevant. Next slide, please. Thank you. Moving on to business combination under common control that do not affect non-controlling shareholders in the receiving company. Such combination could be undertaken by private companies for various reasons, taxation, whatever. For example, in the preparation for an IPO. And let's consider exactly this scenario of an IPO. In this slide here, we have the holding co preparing for this offer of its business, Internet Co and Software Co. In our example, holding co owns Internet Co and Software Co via different holding companies, so it would need to restructure the group in preparation of an IPO. Holding co could undertake the restructuring in a variety of ways. For example, as shown in this slide, holding co could move Software Co under Internet Co, or, yep, thank you. Alternatively, holding co could move Internet Co under Software Co, or it could even decide to merge both businesses into a newly formed company that will be going for this offer. In this scenario, the board's view is that a book value method should be applied. From the point of view of future investors of the IPO, it doesn't matter how a combination has been structured and whether the group even needed to undertake a restructuring in preparation for the IPO. Those prospective investors are newly investing in the same business, regardless of whether Software Co is moved under Internet Co or vice versa. A book value method would generally provide consistent book value information, regardless of how a reorganization is structured. On the other hand, if the acquisition method were applied in this scenario, the prospective investors would receive different information depending on how holding co structured this combination. The information about the restructuring transaction in this case is not important. Next slide, please. Thank you. On the last few slides, I have mostly focused on the information needs of equity shareholders. In developing our preliminary view, we also consider information needs of lenders and other creditors and discussed those needs with users of financial statements that are specialized in credit analysis. The board noted that economic interest held by lenders and other credits in the receiving company is different from the economic interest held by non-controlling shareholders and is limited to payment of principal and interest. Therefore, credit analysis focus on the company's ability to service its existing debt and to raise new debt and requires information about the company's cash flows and debt commitments. That information and the outcome of credit analysis are in accordance with our outreach in general, not affected by whether the acquisition method or book value method is applied to a business combination under common control. With that, I conclude our overview on the board's preliminary view on when each method should apply, and I'll hand over to the EFRAG staff to share their thoughts. Thank you.
So thank you. Can we go to our first slide? Yes. So in general, EFRAG welcomes the IASB project on BCUCC. This project is addressing the issue of lack of guidance in IFRS standards, and hopefully it will reduce diversity in practice in the future. EFRAG also agrees with the scope of the project. More specifically, we welcome that business combinations under common control and group restructurings are in the scope of the project. However, we consider that the IASB should better identify and clarify the concept of group restructurings. EFRAG also noted that common control transactions, other than business combinations, is a wide and important topic that needs to be discussed in the future. For example, the acquisition from entities under common control of equity investments in the separate financial statements, in particular the acquisition of equity investments in subsidiaries, associates, and joint ventures. Finally, EFRAG is asking its stakeholders whether it is important to clarify the meaning of transitory control, which is not addressed in the discussion paper, and whether the IASB has reached the right scope. Can we move to the next slide, please? Thank you very much. So EFRAG agrees that one size does not fit all. That is, neither the acquisition method nor book value method should be applied to all business combinations under common control. In particular, EFRAG supports that the acquisition method should be applied when the business combination affects minority shareholders, subject to some cost-benefit considerations. EFRAG also generally supports the use of the book value method to the remaining types of business combinations under common control. However, as we will see, we suggest some adjustments. EFRAG also notes, not yet, can we go back? Sorry. Okay, thank you. EFRAG also notes that the selection of the measurement method will rely on the definition of public market, and that the description of a public market currently refers to both regulated and non-regulated markets. Finally, on this slide, EFRAG is consulting its constituents whether the IASB decision tree in the DP should be modified, in particular whether step 1 and step 2 should be reversed, and whether the use of the acquisition method should be extended to include also reference to entities that issue public debt instruments or entity with public accountability. So in this slide, we can see the revised decision tree. So the first question is whether step 1 and step 2 should be reversed. Reversing the order of step 1 would provide more relevant information in immediate response to the listed companies, which typically have non-controlling interest. In addition, it would better accommodate EFRAG's proposal to extend the use of the acquisition method in step 1. That leads us to the second question, whether the use of the acquisition method in step 1 should be expanded to situations where an entity issues public debt instruments or has public accountability. So what are the different options that we have in this decision tree? So the first option is in accordance with the IASB proposal, the reference to publicly traded shares. The second option that we have refers to the possibility of extending the use of the acquisition method to privately held entities that have listed debt instruments, even if there is no controlling shareholders. This is because there are concerns about the lack of relevance of the book value approach for debt holders, particularly for holders of hybrid financial instruments that have characteristics of equity. And finally, we have the option 3. This option refers to the possibility of extending the use of the acquisition method for public interest entities which have a wider public objectives, such as banks and insurance companies. Such entities are usually scrutinized by local laws that impose strict accounting requirements. If we can go to the next slide, please. Thank you. So in regard to the IASB proposed exemptions and exceptions, which Tadeu just mentioned, EFRAG supports from a cost-benefit perspective the optional exemption from the acquisition method for privately held entities when the non-controlling shareholders agree. However, EFRAG is consulting constituents whether the related party exception should be optional rather than required. That is, whether the IASB should also allow the use of the acquisition method to privately held companies when all non-controlling shareholders are related parties. This is because it is possible that these non-controlling shareholders do not have information they need about the transaction, for example, investors with significant influence over the reporting entity. So I'm done with the slides, so we go to the panel. Pedro, you are okay.
Good morning. Good morning. I would like to thank to all the participants and especially to EFRAG, my colleagues at CNC, OROC, and also IASB. I shall introduce the speakers in a minute. Previously, I would like to say that we will have some polling questions, some 5 polling questions, 2 during the first topic and 3 during the second topic. These polling questions will show up, and you will have the participants will have around 60 seconds to reply, and we will discuss and analyze the results of the polling questions in the end of the panel discussion of each of the topics. And also, I would like to invite you again, as Saskia asked you before, to put forward any questions that you may want to see clarified. And they will not show up in the screen. The speakers and the panelists will streamline those questions and try to reply to them. Also, in the end of the discussion of the panel, in the end of the discussion panel of topic 1 and then topic 2. Also, thanking very much our guest speakers that are in the panel. I will start with Mário Freire, my colleague, and trying to make a short summary of each CVs. Mário is a board member of OROC. He has been with KPMG and as head of the Department of Professional Practice. He also teaches in ISEG in Lisbon. He has held a relevant position in our Security Stock Exchange Commission, and also has a seat on the Accounting Regulatory Committee in the European Commission, and also in the enforcement coordinating sessions of ESMA. Also a member, as Lucy told us before, of our CNC, the accounting standard setter of Portugal. Nuno Martins, which shall be the second speaker in this first panel, is a partner in PwC. Is the head of the capital markets and accounting advisory services. He covers both Portugal and Angola activities in these areas. He has served in the London and the New York offices of this PwC. He has a degree, a master's degree in the London Business School, and also a colleague, auditor colleague. So as we call Portuguese chartered accountant colleague. Fernando Araújo is, just let me check here. He has a degree in accounting and management. He's a specialist in the financial control. He has been also a statutory auditor. Post-graduations in the advanced financial accounting, tax law, and corporate governance. He started his career in the 87. Also worked in the KPMG in the tax as a tax manager. Then moved on to companies like Cecil, Semapa, and now with Navigator. The last speaker of this first panel will be Filipe Romão. He's a lawyer. He's an expert in tax law, and also his degrees in law, obviously in post graduations, in management, tax, and also security exchange law. He also teaches at our Catholic University in Lisbon. At this moment, I can start with our first intervention of our guest speaker, Mário Freire, in this role. He has different roles in this webinar, but at this moment, I would invite Mário to go forward with your presentation. Thank you.
Thank you, Pedro. Thank you all, and welcome. Actually, the two questions that has been raised to me before this preparation of this webinar is who would be affected by the preliminary views on this discussion paper, and if there are any other transactions that the ESB should consider. Actually, many companies may be affected in Portugal, and I'm sure everyone knows that. We just want to stress that we may have the classic situations where a company, the transferred company, would be sold for another company in the group, receiving company. This is the common one as addressed clearly from the IASB discussion paper. But as the discussion paper point out on point 1.14, it states that may involve also the transfer of unincorporated business, meaning we don't transfer a company, but just part of them, or even part of assets and liabilities of an individual businessman. This is very common in Portugal, where companies may buy from the shareholders or something or other under common control other business, and we could go in situations like legal mergers. So that is another point, and these legal mergers may involve not just transfer a business from one company to a sister company and extinguish the transferred company, or it may be a vertical integration where a company holds 100% of a subsidiary and suddenly want to transfer the business from the subsidiary directly to the old company that is inside of the group. So what we call vertical integration, and that is the most situations that we may face, and this discussion paper would affect. This is the reasons for doing that. We may also find different grounds. Restructuration for reducing the complexity of a group is very common in that sense. We have also another kind of very important transactions, which is restructuration preparing succession in a familiar business. It would also be more reasonable to reorganize subholdings in a group, and that will start to prepare sub-consolidations in order to be allocated to in a succession family plans. This is a very important point that we exist. You may realize that most of the companies are familiar business and not listed or public companies in Portugal. So that is the most areas where we see lots of transactions and restructuration on that kind. Of course, we also have the restructuration for preparing an IPO for a part of the group, or even a private placement, not necessary to be public held, but could be prepared for a private placement for investors and not coming from the securities market, but a private placement. That is also important to take into consideration because there are different needs on that side. It also may be restructuring to prepare, and Filipe as picking up that point, preparing a public interest entity or a regulated entity, and because of that it is necessary to restructure and to have this kind of part of the group that comes to be part of regulated or other thing. That raises the need to the conceptual that also needs to understand exactly the concept of transitory control, not for public interest entity, but the other two that I mentioned. Final point here, and I would conclude. I would state that we should be careful because the concept of business in IFRS 3 changed in 2018 with the application of 2020. Right now, it's the concept of business is an integrated set of activities and assets that is capable for being conducted and merged and managed for the purpose of providing goods or services to customers, generating investment income such as dividends or interest, or generating other income from ordinary activities. We draw the attention that it was dropped, the previous one, that another reason could be lowering costs and economic benefits provided directly and proportional to policyholders or participants. By deleting this from the previous definition, we may narrow the concept of business. And there are other transactions that may not exactly fit on the concept of the new concept of business, but it clears need to be addressed because it being part of this restructuration, and we may face lupus for not addressing this point, because some of the restructurations has in mind lowering costs and getting economic benefits of that. So it was a quick snapshot of these two questions. Thank you.
So now I can invite Nuno Martins to go to the next presentation, please.
For sure. First of all, thank you very much for having me. I want to thank you, the EFRAG, for this webinar. I want to thank the board, the IASB board, for their presence, their insights, their presentation, and of course, I want to thank the OROC and all the effort that is putting on this subject in Portugal, which is quite and is relevant for the preparation of our financial statements, for our position in IFRS and the way we discuss these topics. So the question I had was related with which measurement methods should apply to business combinations under common control. And to be honest, I thought it was really an easy question. Why? Because on the discussion paper, IAS had discussed that point very deeply. So we went through the 3 possible ways to do it. So we can do it an acquisition method, very similar to what is stated on IFRS 3. And this is basically to be honest, and I would like to finalize with that, but I'll give you a clue. In my view, in Portugal, this is basically the way we do things. And I can give you the reason why I think that's most of the transactions under common control for consolidation purpose will follow IFRS 3. And again, I will give you my 5 cents on that and why I think that is the case. That will be the first way to do it, an acquisition method. Of course, we have the book value method. And on that one, we can start to discuss what kind of book value we can use. And again, on the discussion paper is quite straight on that and say we should use the book value on the company that has been transferred. So it's easy to have answer on that. And of course, they start and even discuss a fresh start method or a new basis method. So when we merge the companies, actually we'll fair value both the transferee and the transferred company, or the transferee and the receiving company. Of course, at the end, they narrow down and say, look, I think the way to do this, we can have only 2 options. We have an acquisition method and we have a book value method. And the book value method, again, should be based on the information and on the figures that was carried on from the old business. If you want to go slightly deep on that, I think the quick question is, of course, we have these 2 methods. I agree, and as I think as need to be understood, my views are personal views and are not PwC views. PwC views will be channeled through the formal communications and the response you will prepare. But my view is actually, what should be the discussion is not if there is a difference between the transactions in IFRS 3 and the transactions under common control, but the difference should be what kind of transactions we have under common control that are different, and based on that should be treated differently. So I think it's a different way to put the discussion, and it follows what the discussion paper has, but is looking in a different way. And saying that, of course, if the transaction under common control is more similar to a transaction under IFRS 3, we should apply the acquisition method. If it's more similar, it's more dissimilar, and it's more what was discussed in old times, reorganization, a transaction without substance, of course, we should deal with that in a different way, and we should use a book value. Again, in Portugal in the past, when we tried to use book value, the question was, what kind of book value? And because some manuals, different manuals of the Big Four will talk about predecessor accounting, the way we did it in the US GAAP, we got, when we use it, and again, I think we use it in a very few moments, when you use it, it was a significant discussion what kind of book value used. And again, because if you go to different publications and public information on the Big Four, you will find, if you look to the manuals for 2015, 2014, you will find different ways and different definitions of what is the predecessor accounting. Saying that, and it's closing to my time, saying that, I think the discussion paper, if it moves to a final paper, will have a significant impact in Portugal. Because as I mentioned, most of the transaction in Portugal under common control will apply the acquisition method. Why? And this is actually my last point, is because there was no other guidance. So it was easy to use this one. And nobody will dispute, nobody will judge about that, because you need to set your policy, you need to agree on a policy, and you will get divergence in practice if you do it that way. So it will be easier to use the acquisition method, even if it was costly, even if at some point it doesn't make too much sense when you prepare that kind of financial information. And of course, because you could improve the way you look at your financials, you will revalue your assets, you'll give a different image of your positions. The only point that I think we had agreed in the past was on combined financial information. Because when we prepare combined financial information in Portugal, we tend to use the book value when you do this kind of information. So saying that, again, I think the board on that one gave me an easy ride. So I will stop here and move on the discussion.
Thank you very much, Nuno. Both speakers have been very compliant with the time schedule, which is very nice. It gives me some time to introduce the question, our first polling question in this topic. You will see that in a minute. I will summarize. The question is, what are the most common BCUCC in Portugal? So we have four options. Option A, combination between two subsidiaries leading to a creation of a new subgroup. A combination followed by a legal merger, where two subsidiaries are legal entities and merge into one legal entity. The third option is a transfer of a business that involves the formation of a new entity to facilitate the sale of part of the organization to an external party, like an IPO. And the last option is a transfer of a group of assets that constitutes a business, or transfer of an operating segment from one subsidiary to another. You have now 60 seconds to vote and to allocate your option. In the meantime, we will analyze the results in the end of our panel discussion of this topic one. And at this moment, I would invite Fernando Araújo to go forward with this presentation. Very much.
Okay, thank you. Good morning to all. I have some questions. When should the acquisition method be applied in business combinations under common control? And when should the book value method be applied to the same business combinations under common control? I want to do a step back before talking about these issues. The fact that this change or proposal has been launched is the fact that there is some diversity in the application of the norms or application by the companies. And we should think why the companies have different choices, why they make a different choice. And in my view, as a preparer, I'm not an auditor, I was an auditor in the past. As a preparer, I would say that there are some guidance on this. First, the people will think about what will be the implications in debt. This means if they have some covenants on financial contracts, if will be better for them to apply the acquisition method, or if it is better for them to apply a book value method. I would say that if they are in problems in what concerns debt covenants, they will, and especially net debt against equity, they will try to have a step value on these transactions. This means some of these choices, the fact that the people choose to apply the acquisition method, it's because they can achieve a goal with that and they be in better conditions in what concerns lenders to the company. There are other reasons that could be considered on that decision. The fact that some tax, the implications of tax. In Portugal, for instance, there is no consolidation basis for tax purpose. This means we apply a tax pooling, but it's not a tax consolidation. The people, there is a rule on the law that normally they should apply arm's length. This means they should apply the step-up values on those transactions, but it applies to individual companies and not to consolidated accounts. When we are talking about IFRS, we are talking about consolidated accounts, not individual accounts. But for tax reasons, normally the people try to go for the neutrality on this position. This means that for the tax purpose, normally the people are implied to use the book value method. And especially in the past, since the introduction of IFRS in the Corporate Income Tax Code in 2010, there is no continuation of a former rule saying that in order to apply the neutrality principle, this means not to be taxed on the step values, the people should adopt in the accounting the book value method. This is no longer true. This means the companies could decide to apply the book value method or to apply the acquisition method, and for tax purpose, nevertheless, they are not taxing in the intergroup transaction. And finally, the other reasons that could be considered is in what concerns dividends. The fact that the people will have more dividends to distribute or less dividends to distribute. If we think about the acquisition method, it's good on the first time because we improve our equity, but it's worse in the following years because normally we have higher depreciation or amortizations to be accounted for. This means that explains how the people choose to use the acquisition and book value method. The rules proposed now saying that if the line should be established if the combination affect non-controlling shareholders of the receiving company. I would say that this makes sense to me. In fact, it's a change in economic interest that is change, and for that purpose, I would say that it makes sense to make this option. If there is affecting combination, affecting non-controlling shareholders of the receiving company. I have one doubt, and perhaps could be clarified later on, is in the example that was shown, we have a company with 100% that is transferring a software company to another one that controls 50%. This means it's affecting the non-controlled shareholders of the receiving company. I have a question if it is the other way around, if we apply the acquisition method mandatorily, because it's not affecting non-controlling shareholders of the receiving company. I have some questions, and for us it's important because, for instance, Navigator belongs to a holding company called Semapa, and Navigator itself by 70%, and the other company is held by 100%. And I have the doubt if transferring Navigator to the Cecil group, I have the same effect as transferring Cecil to the Navigator group. But it's something that could be later on considered. There is another thing that puzzles me, is the fact that when we think the main countries or the biggest countries and follow the rules in US GAAP and follow the rules in China or follow the rules in India, they prefer to use the book value method. I have some questions if the biggest companies here, and if you are talking in reducing the diversity, if having this option is really reducing diversity, especially when the bigger countries are outside these options. But I would say that it's a question that could be answered later on. In what makes the decisions on when should the book value method applied, I think it makes sense that if it's not affecting the non-controlling shareholders or receiving company, okay, it's a book value method. And I think it makes sense to have the exception and exemption. If in fact the all non-controlling shareholders of the receiving company are related parties of the controlling shareholder, it makes sense that it is an exception, because in fact the information is still available for the controlling shareholders and it does not rely on the accounts of the receiving company. And about the exemption, I think it really makes sense once again, because a similar exemption exists in what concerns about the publication of consolidated accounts. You can be exempt to publish consolidated accounts if you have above a company with producing the same consolidated accounts. And I think it makes sense a similar approach if the non-controlling shareholders are not objecting to the apply of the book value method. I would say that this is easy to achieve in a private held company. It's not so easy to achieve in a public company. There is some discussion and debate if we should put a threshold on this. This means if a single shareholder could oppose to this exemption. I think a single shareholder is too much. I would say that for me it makes sense to have a threshold at least at 90%, because it's something that it's the requirement threshold to delist the company from the stock market. I would say at least in Portugal, and I'm talking about the rules in Portugal. And I would say that 90% it's a threshold that perhaps makes sense, but perhaps it's not. This rule is only in Portugal and not in other countries. Despite the fact I think the security companies code, it's European, at least it's at European level. But I understand the reasons why this is not applied, because in the fact, if I have 90% of the company, I could launch a mandatory offer and buy the remaining non-controlled shares. But for me, it's something that nevertheless is still debatable, because in a private health company, it's easy to find each shareholder and ask them to not object. In a public company, I would say that it's more difficult. Finally, I want to make some comments about the extending this rule to not only for companies with shares in the public market, but also with the lenders or other entities with the debt quoted in the public market. My personal opinion is I think it does not make sense, because as far as I'm aware, or as far as I understand, IFRS is for mainly for the shareholders. It's not for the lenders. For the lenders, they want to be sure about the prices. They apply not to fair value. The lenders in practice have a prudence. This means they want some prudence. They don't want to have a big number. I recall that in Portugal, there was some debate 1 year ago, a company with a share capital of 100,000 million euros, because the statutory auditor, based in external opinion, said that the software they have deserves that amount of money. This means, for me, it does not make sense to have this in practice. But once again, it's opinion, because the lenders should not rely on the accounts only. They have other grounds to ask information, and for me, it does not make sense to attend to this kind of interest of the lenders. But it's opinion, and I rest my case.
Thank you very much. We will now launch the question number 3, our second question in this first discussion panel. When should the acquisition method and the book value method be used? I will go through we have here some 6 possibilities in this question. You may see it in a minute in your screen. The first one is support the IASB preliminary views in the DP. The second one is to support the IASB preliminary views except the related party transaction exception. That should be optional rather than required. The third option is support a wider use of acquisition method, including when the receiving company has a public debt or old assets in a fiduciary capacity. Option D is a book value method, should always be applied. E, an acquisition method should always be applied. And the last one, a different criteria should be used. So you have now 60 seconds to reply. As I mentioned before, we will share the results in the end of the discussion of the panel. You will see both the results of the question 2 and the question 3. and we will comment on that. And we can move now to Filipe Romão to give us the legal perspectives on this typical disease. Thank you very much.
Good morning. So, well, first of all, thank you for the invitation. I feel a bit like the stranger in the room because usually, you know, lawyers, even if tax lawyers that should know about accounting are outside these discussions, and definitely I don't want to enter into the technical details of what is being discussed, but I think there are some comments that are worth making. I would say on at least on this topic on the three first questions. One is who would be affected. The second one is what type of business combinations under common control may be relevant from that legal and tax perspective. And thirdly, whether there is a view from that perspective on what methods should be adopted, if different methods should be adopted. The first question, who would be affected? I think that my comments are, I would say, of course, from a legal and tax perspective, but I think it's important to say that on one hand, we should have the investor side, but on the other hand, I think we need to worry about the regulation aspect. One thing is the interest that my clients as investors may have in how the approach is made, because tax is in many cases the cause for these transactions, but also there are effects from these transactions on tax and effects from these transactions and restraints in terms of corporate law. But also, of course, we have to bear in mind the legal and tax framework and what the regulator, the tax authorities, will expect, and the legal framework in terms of corporate law will require. The second question is, of course, what type of business combinations under common control are relevant. And of course, again, from a legal and tax perspective, I have to say that only the transactions where there is a transfer of an incorporated business will be relevant. So the typical, the merger and demergers, so legal demergers and demergers, transfer of a going concern, the so-called trespass, and of course a contribution of a business to the capital of a company, because these are the only ones where on the separate accounts these discussion papers will have a reflection and an effect. But actually, it's in many cases the Portuguese companies will apply IFRS on their separate accounts, so it is a relevant aspect. And finally, on question 3, what should be the method? Very quickly, I would say that, to be honest, and starting by the end, and sorry, because again, I'm free to say this because I'm outside the perspective of the accountant. I may feel a bit cheeky to say this. I think that basically, if what we're trying to get is consistency and reduce variety, I, to be honest, would tend to follow the acquisition method. And the reason for that is that in most cases, even if you apply the book value method, both for tax reasons and for legal reasons, you will have to have the cost of applying the acquisition method, because for transfer pricing reasons, because by definition business combinations under common control are made between related entities, for corporate income tax purposes, most of the times there will have to be an evaluation of fair value of the assets transferred, even if there is a tax neutrality applicable, and therefore the reason for reducing costs in applying book value are not there, to be honest, or they are reduced relevantly. And so again, this is looking at it from a general perspective on the legal and tax framework, because if I look at it from an investor perspective, and let me be clear here, I completely agree with Nuno Martins when he says that the practice is to apply the acquisition method. In all the transactions that I have been involved in recent years, and many of the biggest transactions in Portugal, M&A transactions where there were mergers or demergers, the acquisition method was applied. Where under this discussion paper, clearly the book value method would be applied. So in my view, basically in the end, for tax reasons, from the investor perspective, there could be some situations where the book value would be better because, for instance, for real estate transfer tax, for stamp tax where it is applicable, if we apply the book value method, because the tax base is the value for which the assets are registered in the incorporated company, the tax base will be lower. But other than that, in general, investors also, as it has been said here, investors try to do these restructures and try to improve the image of the companies, and so for them to make a step up is much better. And if they could do it on accounting basis but tax neutrally, then much the better. So again, from a tax perspective, in the end, I think that applying the book value, will not be that much in the interest of the investors, will not be that much in the interest or not in the interest of the regulator, and it will not allow a reduction of costs. And finally, in terms of corporate law, it has to be said that apart from the exclusive situations where, for instance, and again, I'm always talking about transfer of unincorporated businesses, and now only about mergers, which are covered by the corporate law. In mergers, basically, except in the case of simplified mergers where we have a company that owns 90% of the other one and absorbs that subsidiary, in all other cases, or in most of the cases, an exchange ratio has to be applied according to fair value. This is defended by all the doctrine. And so, again, in the end, we can apply the book value, but for the exchange ratio, we will have to make the cost of making the evaluations of both assets of both the incorporated and incorporating company. Apart from the fact that, of course, if we have the book value method, there will be, of course, situations where subsequent distributions of profits and reserves will be very much restricted, and again, from an investor perspective, that is not something that is desirable. Then, of course, on the application of the methods, there are other comments to be made, but I think that's for topic 2, and I will stop here.
Thank you very much. It was very useful to have also a different perspective on this topic. And so we are at this moment able to see the results of both questions. So the first one, what were the most common combinations in Portugal of this kind? I believe you can see now the results of the polling question number 2. It is clear to see that the prevalence was to the option B, so a combination followed by a legal merger, where 2 subsidiaries that are legal entities are merging to one legal entity. And the next one was with more votes was really the option D, the transfer of a group of assets to that constitutes a business or transfer of an operating segment from another subsidiary to another. In question 3, we see the first option being the most voted, supporting the IASB preliminary views in the discussion paper, but also nearly at the same level of vote, the last option, a different criteria should be used. For example, price paid in arm's length transaction. So we can see now the results of those first polling questions to this discussion panel. We will now go forward to have our panelists giving their views and also invite other speakers and colleagues that are present here. So can I do a quick round on our panelists about the first reaction to these results, please? Perhaps I would start with Mário. Are you surprised with this or not?
No, actually, it reflects actually the environment and the family business or other kind of restructurations in that sense. I would just draw attention to the fact, because we spoke here about the application of acquisition cost. Maybe when we think acquisition cost in this environment, it would be to identify all the assets and liabilities that exist in the transferred entity. And in that sense, and then we apply the goodwill for the difference. Maybe the application that we could also see in many companies is a simplified method of acquisition cost, which means perhaps we may identify some revaluation of the assets previously identified on the transferred entities, but more reluctancy to recognize intangible assets outside of the goodwill. So we have this kind of approach, and I understand that people try to opt for that because to deal with goodwill, if they use the pure method, book value method, it goes against equity, and then it creates constraints about distribution, as Filipe says, or other kind of questions about solvency KPIs for lenders, which create consequences and restrictions. So that is the way to avoid using book value in the concept that is discussed in the discussion paper. So this kind of approach is to avoid goes net to the equity. It is the way, as it has been said, opt for acquisition method, but in a simplification way. Another point that we need to draw attention is that even if we are not doing consolidation, we are in Portugal, we use the equity method. So for the transferred, the receiving company, even if the receiving company does not provide the subset of consolidated financial statements, they will use for the equity method. So there are great impacts on that if you think from that perspective. So that is another important point from the characteristics for the discussion, just to be more clear about the concept that we are using. It could be misleading if you do not just refer to that. Thanks.
Thank you. Nuno, do you want to comment on these results?
Yes, I can build on what Mário was saying. So to slightly disagree, because I don't see too many room of maneuver to have this application of something between IFRS 3 and book value and having goodwill that is not goodwill under IFRS 3. So we struggle with that. So at least from our point of view, and now it's a mix of Nuno view and PwC Portugal view. And I understand sometimes we go in a different direction, but usually we struggle with that because we don't see where we can get that. Of course, we can develop a policy, but also I never saw a company that states in their financial statements such a policy in Portugal. But again, it's my practice. So that one. The second one that is key, Mário, and you mentioned, and could have a disruptive impact in Portugal is the fact that we use the equity method in most of in SNC we use equity method, and because of that our legacy, and even because I don't like it at all, so applying equity method on individual financial statements, I don't understand when I was in other jurisdictions not used at all, and if it's not relevant, and if you present consolidated financial statements, why have a line with that show me that? Because I'm actually my individual financial statements are used for a different set of purpose. So my second point is we need to be really, really careful with that, because if we still apply the equity method, now we'll never be able to, if we follow under a business combination under common control that will be accounted under the acquisition method. Now a lot of companies will struggle, or we need to do the full exercise on that. And this is something that, again, in Portugal is not usually applied in a proper, detailed, rigorous, as expected way. So I think these are my 2 points on the discussion. And again, just follow on what we are and what Mário was saying, which is quite insightful and critical.
Very well. So Fernando, can you make your comments on these results or any?
Yes, I would say briefly. One, it's the result shows that one size does not fit all, because at the end, the people are still saying that they should be applying different methods in different occasions. If we see the response, the people that say we should always apply acquisition method are few, less than 10%. The people that say we should always apply book value method are less than 10% as well. This means the fact the IASB has saw clearly when conclude that one size does not fit all. The second point I want to highlight is the fact that take in consideration the first one, it's to be humble on the objectives. This means we'll not solve all diversity, we'll only reduce diversity, and I think that is something that IASB is full aware. The third one, and it's clear after the discussion between Mário and Nuno, we are talking that there are different ways to apply book value method. But I think we can conclude that, at least in Portugal, there are different ways to apply acquisition method. Because the people say that they are using acquisition method, but in fact they are not, because they are not recognizing goodwill properly. And I'm quite sure, like Filipe has said, that normally for tax consideration, the people try to avoid that because goodwill is not tax deducted in Portugal. This means we are discussing if there is a difference on book value methods, but we should also discuss there is a difference in the acquisition methods as well. And those are my remarks.
Thank you very much. Filipe, any additional comments on these results and previous comments?
Not really. Just to say that again, from an external perspective, in the end, I kind of think that there are so many variables that reducing variety and trying to get an uniform result will still be better to just stick to one method, which is the one that in practice the companies and the regulator will want to use, which is the acquisition method. Although, of course, that means probably improving the application of it, but I would tend to go for that. But again, that's an external perspective.
Very well. Just before going further to the next topic, we have two questions, as I can see from the audience. The first one is about the current views of IASB, EFRAG, or any of the panelists on both the two topics: previously held interest in receiving companies and the definition of an acquired business in a transaction under common control. I would invite perhaps our colleague from the IASB to comment on this, please.
Thank you, Pedro. Well, actually, that's what's discussed by the panel. I mean, that we have been receiving many feedback in relation to the discussion paper, very rich ones. It is a topic that has already been developed by each jurisdiction, the way that they deal with this kind of transactions. And of course, when we come up with even if it is a preliminary view, even if it is a discussion paper, that's the investigation phase, that's exactly to gather some information from stakeholders. What we can see is that there are support in general for the conclusions, but there are some differences, and most of this difference that we have been we heard is that it's related to some operational questions, and this is quite important for us because if we come up with a solution, it has to be doable, feasible in terms of operational perspective, and also the trade-off cost benefit. We have some questions in relation to, especially when you have non-controlling interest in the transfer or, and then we have already clarified that one, that definitely the focus is on the receiving company, and then therefore we believe that we should not focus on how the transfer is structured. I thought that we have some comments on equity method. This is something as well that affects the standalone financial statements. We may look at that, but the focus on here at this point is the consolidated financial statements.
Very well. Thank you very much. The second question, perhaps I would ask my colleagues of the panel if there are any special impact in the asset management sector. Perhaps I would invite Mário if you have any clues on this.
Okay, that really, it may affect, if it is under common control, on the management sector, that typically we could have non-control entities, and then it would affect on the decision if they opt for applying acquisition method or book value. If don't apply and goes to book value, may affect. Yes, because management sector would try to be more in a way to show the fair values and to reveal such instruments. But in that sense, because I think it may stay the option, it could apply. So that's I would not expect huge consequence if they still apply the acquisition method.
Before closing the panel discussion on topic one, just asking any of the colleagues, both panel and other speakers, if any additional comment or views want to be expressed at this moment. If that is not the case, I would hand over to starting the topic two presentation and discussion of our colleagues.
Thank you, Pedro. I will now move to discuss how the board's view the acquisition method should be applied to business combination under common control. Yeah, this is the right one. Thank you very much. The board's preliminary view is that in principle, the acquisition method should apply as it is in IFRS 3 because non-controlling shareholders are affected in the same way as for any other business combination. The board is suggesting a special feature for bargain purchase that I will show in a minute. Also, the board has concluded that because business combinations under common control are related part transactions, additional information about the transaction price especially should be disclosed. Next slide, please. Thank you. Just as a reminder, applying the acquisition method in IFRS 3 to business combination between unrelated parties, acquired assets and liabilities are measured at fair value. Goodwill is measured as a residual. Economically, the goodwill may include several components, including, for example, an overpayment. IFRS 3 acknowledged but does not require companies to identify and separately recognize any such overpayment because it would be impossible to measure from the practical point of view, and instead any such overpayment will be included in the carrying amount of the goodwill, which is subject to subsequent impairment test. As it is in IFRS 3, in rare cases, a bargain purchase can occur between unrelated parties, but in the case that it occurs, the gain is recognized in P&L, and this gain is measured as the difference between the fair value of the consideration paid and the fair value of the acquired net assets as shown in the slide on the right. Next slide, please. Yeah, no, it's this one. Yeah. The slides are so similar, just a few difference between the two. The board considered whether the logic and mechanics of IFRS 3 should also apply to business combination under common control, because they are transactions between companies within the same group. In theory, it is possible that they include an additional component that cannot be presented in a transaction between unrelated parties. If the price paid in a business combination under common control is higher than would have been paid between unrelated parties, that overpayment economically represents a distribution of equity of the receiving company to the controlling party. In the same way, if the price paid is lower than would have been paid between unrelated parties, the underpayment represents a contribution to equity of the receiving company. So the board considering whether any such distributions or contributions should be recognized. And the board concluded that distributions are not likely to occur for business combination under common control to which the acquisition method is applied, because these transactions affect non-controlling shareholders. Suppose that they are watching what is happening. And even if a distribution occurs, it would be challenging, if not impossible, to quantify it, similar to any potential overpayment between unrelated parties. Accordingly, the difference between consideration paid and fair value of the acquired net asset would be recognized as goodwill, just as occur in business combination between unrelated parties. But as I mentioned before, IFRS 3 already requires companies to recognize any underpayment as a gain. But in a business combination under common control, that underpayment economically represents a contribution to equity, and the board is suggesting applying the existing mechanics in IFRS 3 to measure an underpayment, but recognize it as a contribution as illustrated in this slide, instead of recognizing in P&L as a gain. Next slide, please. One more. Thank you. Now I will move on to board's view on how to apply a book value method. As I pointed out before, book value method is not described in the IFRS standard, and there is significant diversity in how a book value method is applied in practice today. Actually, we talk about book value method, but if you just look at the standard, there is no definition in the standard what a book value method would be. The board has reached a view that a single book value method should be specified in IFRS standard. I mean, that just one book value method. In the board's preliminary view, assets and liabilities received should be measured at their book value reported by the transferred company. I will explain more about this on the next slide when you can see an example. The consideration paid should generally be measured at book value. However, the board suggests to not specify how consideration paid in own shares should be measured, because the board generally doesn't prescribe presentation in equity, and it doesn't have an effect in the total equity, but might have some room for the classification in equity that might be good for the different law statutory requirements in different countries. In relation to transaction costs, should generally be recognized as an expense as it is in IFRS 3. In terms of this difference between consideration paid and the book value of the assets and liabilities received should be recognized in equity, consistent with the current practice. This is something that we are aware is already being made. Pre-combination information, combining companies should be combined prospectively from the date of combination as it occurs under IFRS 3. And finally, disclosures, companies would be required to apply only a subset of the disclosure requirements in IFRS 3. The board has not yet considered, okay, thank you. The board has not yet considered for the detailed aspect of how a book value method should be applied. It plans to consider those further aspects in the next stage of the project once we have the model confirmed. I know that there are some questions in relation, details in relation to the book value method, but I think that it's better just to think about what would be and agree what would be the model, and then in the next phase you can go further into the book value method to describe in detail other ways of doing that. Next slide, please. Well, one area that I said that I would like to explain details, which book value to use. First of all, to explain the issue, let's go back to our example, software co. Suppose that private co previously acquired software co from an unrelated party, and so it applied the acquisition method to report that combination and fair value assets and liabilities of software co at the combination date. I mean that they did the purchase price allocation the time that they made the acquisition. As a result, assets and liabilities of software co are recorded at a higher book value by private co and holding co compared to the book values reported in software co itself. So when software co is later transferred to private co to IT co, the question arises which book value to use, those reported by private co or holding co, or those reported by the level of the software co itself. The board's view is that the transferred company book value should be used in our example software co numbers. This is because conceptually book values reported by the private co and holding co as a result of a prior acquisition have nothing to do with the combination that is happening now between software co and IT co. Next slide, please. Okay. The other area of book value method that I said that I would explain details this pre-combination information, which is one area of diversity in practice that we heard from our stakeholders. In some cases, company apply a book value method retrospectively, like combined financial statements. Under that approach, pre-combination information of the receiving company is restated to include all combined companies from the beginning of the first period presented as if they have always been combined. Still using our example, when software co is transferred to IT co, if a retrospective approach is applied, IT co would restate its financial statements for all prior period presented to include software co under this approach. Next slide, please. And an alternative approach that we also see in practice today is prospective approach. All company entities are only combined from the combination date. Pre-combination information is not restated to include the transferred company. This approach is the same as what happens under a normal acquisition method between unrelated companies. After considering both approaches, the board concluded preliminarily the receiving company should use a prospective approach. The board acknowledged that pre-combination information about all combining companies could be useful. However, providing it on the face of the primary financial statements could involve hypothetical information, would portray a group that did not actually exist before the combination date. But if a company wants to disclose this, for example, this such pre-combination information, the note, I think that it could do that. And now, that's what I would say, and now I'll hand over to EFRAG staff to share, I think it's Chiara, to share their thoughts on how to apply the two methods. Thank you.
Thank you, and good morning to all of you. I hope you can hear me well. On this first topic, the distribution from equity or contribution to equity. On the notion of distribution from equity, EFRAG supports the IASB preliminary view of not developing requirements on this topic, because this would only increase complexity and would be more costly for preparers and would involve significant judgment. The IASB's proposed approach has also the benefit of being consistent with the IFRS 3, where overpayments are dealt with in impairment testing. On the notion of contribution to equity, on the contrary, we are consulting our constituents, and more specifically, we seek views on whether to recognize an underpayment, a bargain purchase in profit or loss, consistently with IFRS 3, or whether to recognize this underpayment directly in equity, as proposed by the IASB. The reason why we are consulting is that there are pros and cons on each of the approaches, and you can see a description in our draft comments letter. For example, recognizing the underpayment in profit or loss may be relevant when we consider that a business combination under common control may involve a loss-making business. However, recognizing the underpayment in equity would minimize any management structuring opportunity, for example, and also be consistent with IAS 1, where transactions with owners acting in their capacity as owners should be reported in equity. Can we go to slide 36, please? How to apply the book value method. In practice, companies often use the carrying amounts included in financial statements of the transferred company or the carrying amounts included in the consolidated financial statements of the transferred company's controlling party, the so-called push-down accounting. Again, also for this topic, we consider that both approaches can provide useful information to users. For example, the use of the book values of the transferred company provides historical information, so it's useful in analyzing trends and estimating future cash flows. It also provides information that is more similar to combined financial statements and reflects the views that the economic resources have been simply moved from one location to another within the same group. Nonetheless, also the push-down accounting can be useful. As, for example, it provides more relevant valuations of the assets and liabilities acquired, and because the consolidated financial statements is for sure prepared under IFRSs, which cannot be necessarily the case for the receiving company's financial statements. So also in this case, we are seeking your views from constituents on current practices and trying to better understand the pros and cons of each approaches. It's not a surprise that on several topics, we, at the beginning of this consultation process, didn't take a closed position because this project has been dealt so far with the different local approaches, and so it's difficult to find a single approach that is suitable for all the different perspectives around the table. Slide 37, please. How to apply the book value method and measure the consideration paid. We generally agree with the IASB views on how to measure the consideration paid. However, in terms of consideration paid in assets, we suggest that the IASB considers allowing the use of fair value measurement, as this information may be relevant for creditors and other lenders. In particular, in light of IFRIC 17, where an entity has to measure a liability to distribute non-cash assets as dividend at the fair value of the net asset to be distributed. Finally, we also are seeking views on if there are any other forms of consideration paid and how common they are. Slide 38, please. Thank you. Remaining topics. We agree with the IASB preliminary view of recognizing in equity any difference between the consideration paid and the book values of the assets and liability received. We also agree with the IASB's preliminary view of not specifying presentation within equity, as the allocation of components to equity generally is not covered under IFRS standards. And we also agree with the IASB preliminary view that the transaction costs should be recognized as expenses when incurred. We agree with the IASB preliminary view that the receiving company should include book values of the transferred company prospectively from the combination date and without restating pre-combination information. We acknowledge that currently local requirement of some jurisdictions require restatement of comparatives and another do not. Thus, the IASB proposal will effectively change some of the current reporting practices. And we are also consulting the constituents on whether the IASB proposal of providing pre-combination information creates issues with current reporting requirements in some jurisdictions or may be costly and difficult to apply in practice. And finally, slide 39 on disclosure requirements. We also support the proposed disclosure requirements in the proposed discussion paper for both the PCUCC accounted for under the acquisition method and the book value method. We consider that these provide relevant information of the transaction. So with this, I hand over to you for the rest of the panel.
Thank you very much, Tadeu and Chiara. It was very useful again to have the views of IASB and EFRAG on these topics. Again, we invite all participants to vote in the panel discussion polling questions and also to put forth any questions for the Q&A that we will take over on in the end of this discussion panel. Just before going on, I would launch now the fourth question, the fourth polling question, which is very aligned with these presentations. So do you agree with IASB preliminary views that in a bargain purchase, the receiving company should recognize a contribution to equity? This is the question. 3 options. A, yes. B, no, the receiving company should recognize a gain. And C, other views. So you will have now again the 60 seconds to vote on these options. And I will now invite Nuno to go forward with his presentation on the topics of how to apply the acquisition method and should the receiving company provide pre-combination information. So Nuno, please go forward.
Okay, thank you very much. I will state again that actually I'm conceiving my views and not PwC views, and on this topic could be relevant to saying that. So let's start with the first one. So how to apply the acquisition method under business combination under common control. And my initial thought when I started to think about it was, why are you having this question? Because there is only one method, we should apply that method. So this is why we have a method, we try to find out on business combination what is different. We get to two main difference or way to separate the business combinations under common control. And now they are asking how we apply the acquisition method. Okay, so let's see what was the discussion about. I think the discussion makes less sense in an economic perfect world. Because what we are trying to discuss is, and basically the assumptions are, the transferred company was previously controlled by one entity that actually will receive the transferred company, will still control this transferred company after the transaction, but actually we have some non-controlling shareholders on this. And these non-controlling shareholders could go as 49% owner of the company that is receiving, 49% of the receiving company, or could be 5% shareholder of, and non-controlling shareholders of that represent 5% of the receiving company. And again, if you look from economic point of view, it will be quite weird that the receiving company will overpay or will not pay fair value. We can also argue that no, but before the group was already had synergies. But again, if we look to transfer pricing, defensive of the non-shareholders, I'm struggling to see how this company was having benefit for these synergies. If he's benefiting from these synergies, that's okay, but he will not overpay for that. He will pay fair value. So again, it's, from my point of view, it's a difficult discussion saying that this company will overpay because legal boundaries, tax boundaries. So, but I understand if it was the case, we can discuss that if we are distributing something, if we are doing this distribution, that actually this distribution will be only for one of the shareholders or for both, because we are overpaying to the controlling shareholder. So the first discussion, if we are overpaying, what we should do, I think it's a no question, to be honest. I'm trying to be more provocative, but based on economics, it's on economics, legal framework. It could happen, because it could happen whatever we want, and the world is prone to that. But to be honest, it's quite weird, and we are trying to find a solution for something that we should not expect to happen. And if it's happened, probably it's from the realm not of accounting. So that's my first thought on distributions. My second thought on contributions. I think on that one, the decision is being quite conservative. It's saying, yeah, even in contributions, we seem like something weird to happen. And we really don't want to have this eating the P&L, and we prefer to have the gain actually recognized on equity. Will be more defensive, will not impact the performance of the company on that year. And even if we look to the economics, will be quite bizarre to have this kind of situation. It's difficult to monitor and to assess. So saying that, I understand how the board is going forward. I'm supporting the view, but we can see it in a different way, and I'm trying to put in a very, I would say, singular way or a more comic way, but comics way in that sense. But this is basically my thoughts on how to apply the acquisition method. So I support it, but I think the discussion is quite weird. It's not weird, it could happen, but sounds like a good answer to a problem that probably will be behind the discussions on accounting. So this is my initial thought on how to apply the acquisition method. Regarding the second question, which is actually a completely different question, is about what kind of information the receiving company should provide regarding pre-combination and the transferred company when applying the book value method. So now we are talking about what we should report and how should do the reporting on a world that the acquisition was accounted under the book value method. And I totally agree with what he's saying. Is we should do it prospectively. I don't understand why we should start to do it retrospectively. I know that some jurisdictions does that way, but to be honest, similar book values, previous P&L. I'm not sure why we should do it in a different way. And the way the disclosures are being presented are quite sensible and will provide the information that is required in such transactions. So I think these are my thoughts on these two questions. The first one a little bit more provocative. The second one much more straight to the point and very, very comfortable what was presented and proposed by the author.
Thank you. Before moving on, I will launch now the next polling question, question number 5. Which book values should be used? Again, we are discussing this topic of the book values. Option A, use the book values in the consolidated financial statements of the ultimate controlling entity. Option B, use the book values in the financial statements of the transferred company. Option C, depending on the circumstances, either approach might provide the most useful information. So in the next 60 seconds, please vote. We are having a good response from the audience and from the participants, and so please go ahead. And now we can hear Fernando on these next questions related with how to apply book value and should the receiving company measure the assets and liabilities received at book values and so on. Please, Fernando.
Okay, I think on questions about book value are 3 main questions. One, it's what book value should we adopt? If the book value of the controlling company or the book value on the transfer company. I would say that I agree with the views of IASB. Controlling company, it's not involved in the operation. I consider the fact that we could say that the values of the controlling company due to a prior acquisition are more updated. But I would say if we want to have updated values, we should use acquisition method. It does not make sense for me to use controlling value of the assets controlling value, especially with that argument, because that argument, I would say, proves too much. If we are saying that data is important, we should use acquisition method. The other thing, it's about to apply this retrospectively or prospective in the following prospective approach. I would say that it's easier. It's more, the people could have more savings to use prospective approach. This means they don't need to do the restatement of the accounts on prior years, 2 years or 3 years, it depends. And I would say that normally in Portugal we have some tax considerations on this, and normally we have the opportunity to apply the retrospectively up to the beginning of the year of the reporting year. But I would say that it's totally different. We are not talking about consolidated accounts. We are talking about standalone accounts. And I think we could not mix the two things. For me, it makes all sense to have a perspective approach. It's easier, and it's for the no time and consuming and no cost consuming. And even if we talk if we want to have a retrospective approach, we need to consider, I'm not supporting that view, but we need to consider when we have companies with 2 different year ends. And in some cases, there is some debate in literature in Portugal, and especially in what concerns tax matters. The other thing about the expense of transaction costs, I think it's plain vanilla. It's simple. It's normally recorded as an expenses unless it is related with the emissions of shares or financial instruments. That it's different. There is a rule different in IAS or IFRS, and I think it's easy to record the transaction costs as an expense. I want to finalize my intervention is to talk about the fair value measurement of consideration paid. I'm totally against it. I don't see. For me, it's a code with wings. Or we use acquisition method, or we use book value method. Talking about fair values in book values, for me, it does not make sense. For me, it's a code with wings, or like our government in Portugal, it's a flying cow. It's something that does not make sense to me. It's once again diversity, and that's why I support in this case the EFRAG view on what concerns acquisition method. If there is a difference, should be profit of the year, because otherwise it's like George Orwell's. It's in animals farms when it's an acquisition method different from the other. For me, if we apply the acquisition method, we should apply the acquisition method in full. And if the rule is recognized as a profit of the year, any difference, we should recognize as profit of the year. To apply a book value method or to apply acquisition method with some small caps like in insurance contracts does not make sense to me, but it's only my opinion. And I rest my case.
Thank you very much, Fernando. I will launch now the last polling question number 6. In your view, should the receiving company be required to provide pre-combination information about the transferred company? 3 options. A, no, even if it is not required, and it can always provide information in the notes. B, yes, it should be required in the notes. C, yes, in the primary financial statements, at least in some cases, for example, in IPO. So you have again some 60 seconds to reply, and we can move now to Mário to present his views on this topic that if should the IASB require the receiving company to recognize a distribution from or a contribution to equity when applying the acquisition method.
Thank you, Pedro. No doubt that this is complex. No doubt that the concept of distribution may lies with maybe linked to the legal concept of distribution dividends, and may create complexity because of different jurisdictions. So at least we should avoid these concepts in a way that could be misleading from for instance, the way of distribution. From another point, I understand the question that has been raised because it links to the concept, the concept, the framework, which says that if a gain or a loss from generate to an entity by a shareholder acting as shareholder should not affect P&L and to be to equity. That we should not forget that. And I understand the constraints that we have on dealing with this, especially on business combination under common control. And this is clear transactions from shareholder and capacity of shareholder. That may create constraints. I would challenge. First, I agree with the idea that Nuno says, and to clarify, if we use acquisition method, should use acquisition method without change the concept and should be full applicable the acquisition method. Fair value with identified assets and liabilities, no matter if it is recognized in the transferred entity or not. If it is acquisition method, full IFRS 3. The question could be if the bargain purchase, if there is a bargain, it could really recognize in results because it's something that is business under common control with the shareholder, and that I understand the view that why not this is a contribution. This is a kind of contribution should be the effect on equity. I tend to understand and support such view on the bargain purchase. Regarding the goodwill, no doubt, treat as goodwill, no question. When it is used book value method, and we understand that there is different methods to use the book value, the question is how do you treat the differences? And it's the way of arm's length transaction. It is very complex and Fernando enhanced that. It is very complicated to define the arm's length transaction of a business because the unit of account is the business, not the share. And because you have the control premium inside, it would be very different. If you look to the takeover bids that exist on the market, you have the revised prices. So what would be the arm's length? It would be very complicated, and we should avoid complexity and on a complex accounting treatment that exists. We do not need to enhance, increase complexity in that sense. Does not the pros and cons, there are more cons than pros on that approach. Even try to, on applying book value, perhaps why not think that the difference between the asset liability that we find, okay, would not call goodwill. It could be called synergies or amount that entity are able. And it is transparent that we pay more than what was on the books of the transferred entity. Why not keep it that? The question is, should be amortized as goodwill in Portugal and in Europe? I would say, why not treat this difference as like goodwill, but not call goodwill just to avoid misuse of what is the acquisition method, and call synergies and deal that as amortized in certain period. That would reduce complexity, because people who try to avoid in this business combination that suddenly you will have an impact directly in equity, and add to that as distribution, that creates some complexity in the analysis. And don't forget that I would not be sure if the usefulness of the information as reducing of equity in that sense, it's really the proposal for lenders and other stakeholders by looking for that financial statements. So that's the first reaction on that. I would say that yes, bargain purchase, that makes sense. Regarding the distribution, I would be more cautious on that. So I avoided that concept. And why not this route of dealing as synergies? And that is more linked what people are get used for, and it also help to apply the equity method at the same time.
Thank you very much, Mário. We can now move to the presentation of Filipe on legal and other perspectives at the end of this panel discussion of guest speakers. Thank you.
Basically, and again, I will not enter on the intricacy and the technical aspects of both methods, but I just want to call the attention to possible reflects of this and how it is being treated and how it's being proposed in terms of tax effects and corporate law effects. First, on the acquisition value. I completely understand the rationale to consider on a bargain purchase the treatment of the badwill has a contribution to equity instead of a gain, because it's not really something that has been obtained by the company, but it's rather a reflect of a decision of the controlling company. But to be honest, and going back to what Nuno was saying, I really struggle conceptually to accept that between related entities there is a bargain purchase. Because how can a controlling company decide that one of its subsidiaries is desperate and needs to sell to the other one? For a value that it's inferior to its to the fair value of the assets and liabilities. So, well, and let alone, of course, this being completely contrary to transfer pricing rules. So I really struggle conceptually in the real world to accept that. But let's accept that it is a contribution to equity on the basis of the principles that we were discussing. I just want to call the attention to the fact that then we may create an inconsistency with IFRS 3, which treats this badwill as a gain. And then I just refer very, very shortly to the fact that that gain in Portugal for the tax authorities, is a taxable gain, apparently, which I don't agree at all, because it is potential. It results from an evaluation of the assets and liabilities after the acquisition, and so it should only be taxable when it is realized, but it's a big discussion. And my point is, could we get to a situation where if we have a business concentration in the common control and a bargain purchase is treated as a contribution to equity, there's no tax issue because a contribution to equity clearly is not taxable. But then we have the discussion on a real business concentration where fair values were applied and we will have the tax authorities taxing the gain. It doesn't make sense to me. So again, I understand the rationale, but I just call the attention to the consistency here. And also apart from the fact that on a corporate law perspective, if it's treated like a gain, is the resulting reserve distributable by the company? Well, if we say that is actually a fair value adjustment, then that will serve to defend my argument against the tax authorities that it cannot be taxable. But if the tax authorities say that it's taxable, then I will say that it is distributable, because one thing cannot be the same and it's contrary at the same time. So again, it's just that point. And if it's not, and if it is distributable, then if it is a contribution to equity, clearly it should not be distributable in principle. So again, I just call the attention to the inconsistencies that these things may create on a tax and legal perspective. Book value, very quickly. The only thing that I would comment is that when the consideration is in assets, again, I'm not saying that, I'm not entering into the discussion of whether it should be book value or fair value, but please consider that for tax purposes, it has to be considered for fair value, or the fair value has to be considered, because there's a transfer between related parties, and the taxable gain is subject to tax. And then I end with something that probably will destroy all my credibility, because it's a doubt that I have, which is, and maybe it's an absurd doubt, but I seem to have understood that when we apply the book value and there is a pre-goodwill, or there is a goodwill in the incorporated company, for instance, on a merger, that applying the book value will mean that the incorporating company will not register that same goodwill, but will simply register the assets and liabilities. If that's so, I would assume that it is normal that the incorporating company has a consideration that reflects that previous goodwill in principle, and that means that we will reduce the capability of distribution of dividends by the incorporating company by having a negative reserve. And it seems to me that it's a bit artificial, because if the goodwill was considered as valid and was even acquired by the incorporated company, why should it be de-recognized in the incorporating company? But again, it's a doubt that I have. Maybe I'm saying something that is completely absurd, but if it's not, then I don't see the result as something that is very consistent. Thank you.
Thank you, Filipe, very much. We can now move on to to see the results of our three last polling questions. I can summarize that for question number 4, there was a prevalence on the first option. When the question is if you do agree that IASB preliminary reviews that the bargain purchase should be recognized as a contribution to equity, it was a strong prevalence of question A, saying yes. When we look to the next question, question 5, the prevalence is to option B. So which book values should be used, and what option B is use the book values in the financial statements of the transferred company. The last question, question number 6, was also the prevalence of option B when asking if the receiving company should be required to provide pre-combination information about the transferred company. The reply with more votes was B, yes, it should be required in the notes. Once again, I would go on the tour with our panelists on commenting briefly, as we have been lying strictly with the time schedule, and asking you a quick comment on these results that are being shown for the polling questions 4, 5, and 6. I would ask first Nuno to quick comment.
Sure. I think that my main conclusion is actually that the pool was quite aligned with EASB view. So I think the discussion paper was quite informative and quite convinced, with the ability to convince the readers that this is the one route to follow. So actually on the bargain, everybody's, or not everybody, but more than 70% was saying that the contribution should be recognized in equity. We have discussed when and if it is possible, but if it is the case, and applying S1, a shareholder acting as a shareholder, so we should recognize in equity. So I think that was a good use. So I think I can comment on that, and probably my colleagues could comment on the following ones.
Okay, next, Fernando, please.
I would say that it was a surprise on the second one, the fact that I would expect it's more consensual that the transfer book value, the transfer company booked value should adopt. It seems that it was received by supported by 42%. But in a small distance, 36, it's someone choosing some option, saying it should be an option. In some cases, we should use as predecessor book values the ones of the controlling company. In some cases, we should use the transfer book values of the company. For me, I would say that it's a surprise. It's not such a surprise. The first question, the fact that it's in equity, it's I would say in conceptual thing, it makes sense. Like I have said in my prior intervention, I would say in consistency view or thoughts, for me it does not make sense. In the last question, once again, I would say it's a surprise for me, the fact that people want some burden. The fact that they want to publish, to disclose in the accounts, 52% say that it should be pre-combination information in the accounts, should be disclosed in the notes. I would say that for sure some pre-combination information should be disclosed, but always the question is in degree. If we are talking about the restatement of the accounts, I think it's an excessive burden. But I would say, at least for a transparency purpose, it seems that the people want more transparency in the disclosures or in the notes.
Very well, Mário, can you give us your views on this?
I would like to pick up the last answer. It's interesting where it may depend on what kind of transaction that we are talking about. If we talk about legal mergers, maybe some questions about the period starting from the 1st January to have a complete period with a combination, with a combined P&L makes more sense. It's the common application in order to avoid to get a quick idea of what is the period for tax proposals also. So that should be cautioned, not in the notes but directly in P&L since the 1st January of that period. I agree with Fernando not to go to restatement the previous period. No, not at all. Okay, provide some information in order for someone who looked to the financial statement to look what could be a comparable, but in the note, some information that would help. But I'm more cautious about if we are under the concept of combined entities, because we are under common control, why not think to push a little bit for the period? Because if the transaction occurred in the middle of the period, at least we have the combined performance of that year. That's my comment on that.
Okay. Filipe, can we have your views on these results?
Well, no additional comments from my part. Yeah.
Okay. Thank you very much. We are now in nearly the end of our panel discussions. We have one question from the third question, so from the audience, that I would invite our panelists to consider is the treatment of previous interest held in the receiving company, revaluation through equity or through profit and loss. I would invite Nuno, if Nuno can give us your views on this, please.
Sure. So basically, the question is, because I'm difficult to read here, is the treatment of previous interest held in the receiving. The previous interest held by?
I think it's held by.
No, held by. I'm trying to understand who owns that.
By a controlling company, I would say. But perhaps Tadeu could help as well.
Yeah, actually, I understood the question.
Okay.
And yeah, no, and I think that I might be wrong, and I hope that the project team is not going to crucify me because I'm saying that. But I think that we have not clearly addressed this in the discussion paper. But the point is that, in my view, it's a personal view, I think that we just apply the IFRS 3, and then therefore you need to do, depending on how you are accounting for this interest. I mean, that you have the point here, Nuno, is that they are asking, and I think that wasn't the first question. I also didn't see exactly that coming. But reading this after I understood, they said that I have 10%, let's say, or 20% interest in the transferee, the transfer company, before doing the business combination and the common control. And how should I account for that one? And that's a very good question, because I believe that if you are applying the acquisition method for this business combination and the common control, I suppose that you just follow IFRS 3 and you do the step acquisition procedure. And in this case, probably the answer would be P&L. The difference is slightly different from the gain between in a bargain purchase. I think it's different, but it's if it is book value method, and then in this case, I think that any difference between what we had before and what we are bringing to the balance sheet should just go to equity as any other difference before. Everything is treated as if it is a kind of stakeholders transaction. And Pedro, if you allow me just to reply to one comment from Filipe Romão, I think that he said that on the goodwill of the acquired company, when using the book value, I think that he asked it one. If the goodwill is there, would this disappear? It depends. If the goodwill is at the level of the transferred entity, and then in this case, it comes to the book value. If the goodwill is at the level above, because you did a purchase price allocation exercise and wouldn't have just the goodwill, probably have the fair valuation of some assets here, and then in this case, it would not go because you are just using this level of the transferred entity. And then it depends where the goodwill sits. If it is at the level of the transferred company, it goes together with the other assets and liability. Otherwise, if it is above, it will not go in this book value method. But just to clarify that, especially in relation to book value method, the board is still working a bit more in the details, but we are going to do that in the next phase. Thank you very much, Pedro. Sorry, Nuno, because I have this.
Yeah, because it needs to be in a specific situation. Okay, got it.
No, and not only this, I mean, I also did not see the question. That's the point.
Okay.
Thank you.
Thank you very much. I don't know if there is any other comment from the panelists or the speakers at this moment. We are right on target. I would like
just to clarify something. I noticed that there were a couple of comments about the historical information, but usually this is a request from users that they want to see the trend analysis to be able to estimate future cash flows, and particularly for IPOs. That's why there is this request for historical information and so retrospective applications, so to help them make an analysis of the trends and estimating the future cash flows.
Thank you, Filipe. I was just wanting to thank you very much to the guest speakers. It was really great contributions from you, and also from other speakers from IASB, EFRAG, and all the other participants that have put forward their questions and their views, and also to the team that is taking care of all the polling questions and answers, and taking care of making so much easier the role of moderating this with you. Thank you very much. I pass on now to Luisa.
Hello, good morning all. I'm Luisa Anacoreta from CNC, and I just want to rely the attention for some important issues that were discussed here today. We have a discussion on a project of IASB that results from diversity in practice, because we don't have a standard that concerns business combination and the common control. And as we listened today, business combination and the common control are very common in Portugal, and we have doubts. And as our panelists, or some of our panelists said, we tend to use only one method, that is the acquisition method. As Nuno said, it's how we do things. So we want to discuss this project of IASB because it will have major impacts in our companies, in our accounts. We discussed the topic with preparers, with auditors, and with a lawyer tool, and that is very, very important. Why? Because we may not want it, but this project will have impact on individual and separate accounts of companies. And when this happens, we will have impact in tax and in corporate law, as all of our panelists talk about it. So maybe the discussion here was different from other perspectives, but it's the impact in Portugal, and we have to discuss it. We just to point out that some important issues. Maybe the costs are not a reason not to use the acquisition method, because maybe we have to access the fair value anyway. As Filipe said, and Nuno too, I think they both point out this issue. Another important point is our panelists are convinced that the IASB will not reduce the diversity in practice, because we will still have different ways of doing things, based maybe in Portugal, based mostly in the acquisition methods. Another important topic is whether the non-controlling interests should be the key point on the discussion. We have another way to differentiate the methods. We can look to the substance of the transactions instead of having or not having non-controlling interests. And if we have, should we define a threshold or not? Some questions that IASB and EFRAG could address in their projects. Another point that raised up was whether this project is more a theoretical project than a practice applied project. We have economic reasons and theoretical reasons, but maybe in the practice we cannot attend just the way we want to attend to the theoretical reasons. For our audience, I think we have many auditors. Almost all the audience are auditors, so we have some bias on the answers from the audience. But we can see that even within the auditors, we have different perspectives. So this is not an unanimous project, and we have not a clear position and a defined position on this. Preparers want simplicity. It was very clear from Fernando. The preparers want not complexity in the accounting rules, and the positions and the proposals should look at the practice and the relevance of the issues, of course. I think the important issues that I want to point out are said. Thank you very much for all the panelists and for IASB and EFRAG because for their contributions. And thank you all. And please, Pedro. I think Pedro or Mário.
It's me, actually. Thank you. On my capacity as board member for OROC, I would like to thank you all for being with us today to share your experience on this important area, and it's currently out of scope from the accounting standards. My first message is welcome the initiative for having this discussion paper from EISB, and to encourage EISB to proceed on this relevant project. As you may see, that has a great impact. I also welcome EFRAG for the efforts that they have been taken to drive this initiative for debating business combination and common control all around Europe and provide important insights for this global debate. By starting address this area with a discussion paper, it provides the opportunity from EISB to explore different routes and different approaches and assess pros and cons on those different theoretical solutions. The answers to the questions that has been raised today to the panel participants and from the audience reveals from relevant as this topic in our business environment and how many aspects should be taken into consideration to address different pieces of this big puzzle. The Institute of Statutory Auditors in Portugal, OROC, has been in the first row to promote and to help to drive strong principles in this important area of accounting and affects many companies and transactions, as we could see. I'm sure that by hearing different stakeholders in different jurisdictions like today, the IASB will be able to achieve an important core principles for dealing with this topic. And after due consideration, with the support from EFRAG, may go quickly for the next step to expose draft. And soon we'll fill the gap on the international accounting gap. And it's very important, I urge, to fill this gap because it has a great impact. Even if we do not get a complete convergence, at least we may reduce the differences and define core principles for accept such differences. OROC and CNC will be always here, and you can count on us for the support that you may need on this journey, that I think is a big journey. I hope that this event may help all of us to understand and provide relevant insights with great value for this debate. And thank you for attending this webinar. All the best, stay safe, see you next time.